Welcome to the Deep Dive, where we take stacks of information, your articles, research notes, and, well, we cut through the noise.
We find those key insights give you that shortcut to being truly well-informed.
Exactly. Maybe with a few interesting takeaways along the way.
Hopefully.
Today, we're plunging into Heineken Malaysia, a major player, obviously, in the Malaysian beverage market.
Huge.
Our mission is to dissect their latest quarterly report, Q2 FY2025. We've talked about them before, so we're building on that.
Right, looking at the continuity.
We look at the numbers, track trends over time, see if there are any, red flags popping up.
And even touch on how broader national plans like the 13 MP might shake things up for them.
Yeah, the big question really is, can a market leader like Heineken Malaysia truly, thrive when facing shifting consumer habits, rising costs, maybe new taxes?
How do they navigate those waters? That's what's fascinating, is not just the raw figures.
Yeah.
We're trying to get to the why behind the performance. What does it mean for their long-term resilience, their strategy?
You get the full picture. Market shifts, policy impacts, the works.
Let's do it.
Okay, let's unpack this. Heineken Malaysia's Q2 FY 2025 results. Now, on the surface, the headline numbers, they show a bit of moderation.
Yeah, slow down.
For Q2, revenue was RM 539.7 million. That's about a 5% decrease compared to the same quarter last year.
Right, down from about RM 565 million.
And if you look at the first half of the financial year, 1H FY 2025, revenue hit RM 1.3 billion.
Also down about 4% year-on-year from RM 1.35 billion. It's a consistent trend there.
And then we look at profit before tax, PBT. Q2 PBT was around RM 109 million.
Down 9% compared to last year's Q2.
And for the first half, PBT eased by 4% year-on-year, landing at RM 270 million.
Okay.
Now, net profit, or, core PATMI, as the analysts like to call it, profit after tax and minority interest, basically what's left for the shareholders.
The bottom line, essentially.
Yeah. Q2 net profit was RM 82.996 million. Let's call it 83 million.
Okay, and that's also down 9% from Q2 last year.
Right. And the first half core net profit, RM 286.0 million, a 3.7% year-on-year decline.
So revenue and profit both showing that downward pressure in Q2 and the first half.
Exactly.
Now, if we connect this to the bigger picture, these results, they actually came in below expectations.
Oh, really? Below analysts' forecasts?
Yeah, below both HLI research and the general consensus forecasts. Their first half earnings only accounted for about 44% of the respective full-year forecasts.
Wow, okay. So that suggests analysts thought things would be a bit stronger.
It does. It points to maybe a more challenging period than anticipated. The headwinds might have been, a bit tougher than modeled.
That is a significant miss. So, okay, beyond revenue and profit, what about other key financial health indicators? What do they tell us?
Well, let's look at earnings per share, EPS.
Right.
For Q2 FY 2025, basic EPS was 27.47 sen. That's down from 30.17 sen in Q2 last year.
And the first half followed that trend too?
Yes. 1H FY 2025 basic EPS was 67.91 sen, decreasing from 70.71 sen in 1H FY 2024. So less earnings per share unit.
But interestingly, the dividend.
Ah, yes, the dividend. The board declared a single-tier interim dividend of 40 sen per stock unit for FY 2025.
And that's the same as last year, right?
Exactly the same. Consistent with the 40 sen declared in 1H FY 2024, payable October 30th, entitlement date October 9th.
That consistency is quite noteworthy, isn't it?
Yeah,
Especially with profits dipping.
Absolutely. It's a signal. While profitability metrics are down, maintaining the dividend suggests management confidence.
Confidence in what, exactly?
Cash flow.
Yeah, confidence in their ability to generate enough cash to keep returning value to shareholders. It offers some reassurance, despite the current headwinds. It's a balancing act.
Definitely a balancing act.
Yeah.
Okay, what else? Net assets per share.
As of June 30, 2025, net assets per share stood at RM 1.32.
Which is down from the end of last year.
It is, yeah. Down from around 1.79 at December 31st, 2024.
Okay. And finally, margins. Always important.
Crucial. EBITDA margin for Q2 FY 2025 was 24.7%. That's a slight erosion, 0.7 percentage points year-on-year.
And EBIT margin also saw some erosion in Q2, down 0.9 percentage points to 20.5%.
So pressure on margins too.
In Q2, yes. Although, looking at the first half, the operating margin, the EBIT margin, remained relatively steady at 21.1%.
Okay. So the squeeze was more pronounced in the second quarter.
It seems so. It really signals a company grappling with both, top-line challenges from sales and also some internal cost pressures starting to bite, especially in Q2.
That margin erosion is definitely key. Tells us how efficiently they're turning sales into operating profit. Fundamental health check.
Exactly.
So these numbers paint a picture of moderation, the slowdown. But why? Let's dive into the trends behind this. What actually drove this performance in Q2?
Well, looking year on year, the sales dip, that 4.6% decline, seems largely down to cautious consumer sentiment. People are just being more careful with their spending.
Makes sense? Did management give specifics?
They did. They highlighted a shift. Consumers are buying more from supermarkets, convenience stores, the off-trade channel.
Ah, so drinking more at home, less in bars.
Precisely. Less spending in the on-trade segment, particularly bars, apparently. It's a clear trend.
Okay, that covers the year-on-year. What about the quarter-on-quarter drop? That was much steeper, nearly 30%.
Yeah, revenue down 29.3% in Q2 from Q1. That sounds dramatic, but it's mostly about timing.
Timing, how so?
It's mainly due to the high base effect from Chinese New Year celebrations, which were concentrated in Q1.
Right, CNY drive sales.
Exactly. And then you get the typical post-festive normalization, demand cools off. Plus, this year, CNY was in January 2025.
Okay.
Which means a lot of the stock up, the sell-in activity for retailers probably happened earlier, maybe even late Q4 2024.
Ah, whereas last year?
In 2024, the festive boost kind of spanned both January and February, all within Q1. So the 2025 Q1 boost was more front-loaded, tapering off after January.
I see. So that explains the big Q2 drop compared to Q1. It's not necessarily a collapse in demand, just timing differences.
Largely, yes. And interestingly, their main competitor, Carlsberg, saw something similar. Their Malaysia operations reported a 25% quarter-on-quarter decline, so it seems industry-wide.
Okay, that context is important. It's not just a Heineken issue.
No. But while the CNY timing explains the QOQ drop, that underlying cautious consumer sentiment and the shake to off-trade, those are more fundamental trends.
Trends they need to address strategically.
Definitely. And that links to the margins, too. We saw weaker than expected margin performance in Q2.
Right, you mentioned higher costs.
Primarily attributed to higher costs from ongoing digital infrastructure investments. They're implementing Heineken's digital backbone DBB and easel platforms.
What are those exactly?
They're designed to enhance operational efficiency, improve order management, big tech upgrades.
But they cost money up front.
They do. And those investments hit the margins in Q2, leading to that steeper 32.4% decline in PATMI quarter-on-quarter.
Okay, so that raises a key question. Are these higher digital costs a temporary blip, or are they going to stick around?
That's the million-dollar question, isn't it? Management hasn't explicitly confirmed if these costs will continue into the second half of 2025 at the same level, but they have described it as an ongoing process to improve operational efficiency. That phrasing suggests, related expenses might continue beyond just Q2.
So it sounds like a strategic investment, investing now for future gains, future efficiency.
Exactly. It's a strategic trade-off. Investing now, potentially impacting near-term profits for long-term operational strength and competitiveness.
Makes sense in a long game. But for investors focused on the next quarter's results, those persistent costs might be, well, a concern.
It's a balance, yeah. They're betting that the improved efficiency and maybe better customer connection from these platforms will eventually lead to stronger, more sustainable margins.
Outweighing the initial pain.
That's the plan. Short-term pain for long-term gain. The classic strategy.
Okay. So given these pressures, cautious consumers, shifting channels, investment costs, what are they actually doing about it? What are Heineken's strategic moves?
Well, one very direct move is a price increase.
Ah, okay. How much?
They announced a 2% to 8% increase on beer prices. It already kicked in August 1st for the on-trade channel bars and restaurants.
And off-trade. Supermarkets.
That comes September 1st. Analysts are expecting some front-loading of volumes in the current quarter, Q3, because of this. People stocking up before the price hits.
We've seen that before, right?
Yeah.
Does it actually work long-term, raising prices in this climate?
Historically, for brewers, the financial impact of price hikes has often been neutral, maybe even slightly positive rather than negative.
Why is that?
It's supported by relatively inelastic demand for beer. People tend to keep buying it. Heineken's own measure puts that inelasticity at 0.94.
So basically a 1% price increase only leads to a less than 1% drop in demand.
Pretty much. It suggests that while these hikes might dampen volumes a bit in the short term, maybe Q4 sees a dip. Demand is expected to normalize over time. It's a product with sticky, entrenched consumption habits.
So they're leaning on that inelasticity. What else?
Their broader strategy focuses on navigating this dynamic landscape with agility, driving top-line growth through targeted commercial initiatives.
Marketing, Promotions.
Presumably, while also maintaining disciplined cost control and pushing for that operational efficiency we talked about to sustain healthy margins. And it all fits under their big evergreen strategy.
Evergreen, right? That's their long-term plan to future-proof the business.
Exactly. It's about balancing growth, profitability, efficiency, sustainability, all of it.
Okay, so they have a plan. But beyond these quarterly numbers and strategic responses, are there any bigger red flags, significant headwinds we should be aware of long-term?
Well, as we just discussed, those ongoing digital investment costs.
Right, they could continue to weigh on profits.
That's definitely something to monitor. Beyond that, regulatory headwinds are always a key risk in this sector.
Taxes, basically.
Yeah. The government recently extended the scope of its pro-health tax to include brewers. And there's been support expressed for potentially increasing cigarette taxes, too.
Which could easily spill over to alcohol again.
It could. And higher taxes generally lead to near-term volume moderation for brewers. It puts pressure on sales.
That's a real risk. It also raises the issue of illicit trade, doesn't it?
Absolutely. That remains a major concern for Heineken and the whole industry. If legal prices go up too much due to taxes,
it can inadvertently boost demand for cheaper illegal alternatives.
Exactly. Heineken actually commends the Customs Department's enforcement efforts on this front. They know it's a risk.
Are they doing anything proactively?
They say they continue to collaborate closely with authorities to combat illicit trade. That includes things like promoting greater awareness in the market about the issue.
It's a tricky tightrope for everyone involved. The government wants tax revenue and health outcomes. The company wants stable volumes. And nobody wants the black market to grow.
A very delicate balance indeed.
Now, here's where it gets really interesting, I think. Despite all these challenges, the profit dip, the cautious consumers, the regulatory risks, our source material highlights a really strong financial moat score for Heineken Malaysia, an impressive 8 out of 10. First off, what exactly is a financial moat?
Think of it like the moat around a medieval castle.
Okay, protecting it.
Exactly. A financial moat refers to a company's sustainable competitive advantages, things that protect its long-term profits and market share from competitors, the invaders trying to breach the castle walls.
And 8 out of 10 is strong.
Very strong. It indicates a company with significant durable advantages. For Heineken Malaysia, this comes mainly from its robust financial health, its clear market leadership, and, as we discussed, that sticky, inelastic demand for its products.
So even though Q2 profits were lower,
its fundamental strengths, its moat, position it well to navigate these kinds of storms. The score suggests that despite temporary setbacks, the core business remains incredibly well defended.
That's a powerful concept. Okay, so let's break down those core strengths contributing to this 8-10 moat. What are they specifically?
Well, one of the most significant highlights, almost unheard of these days, is their debt level, or rather lack of it. As of June 30, 2025, Heineken Malaysia has fully repaid all its borrowings.
All of them. Zero debt.
Zero outstanding debt. They paid back RM 80 million just in Q1 this year.
Wow. That gives them incredible flexibility, doesn't it?
Exceptional financial flexibility. It significantly reduces financial risk. They're much more resilient to economic downturns or unexpected costs compared to heavily leveraged companies.
That is remarkable. What else builds the moat?
Strong cash flow from operations, or CFO. We touched on this. Net cash generated from operating activities in the first half was robust, nearly RM 197 million.
And that included that big turnaround in Q1.
Yes, generating over RM 121 million in Q1, a huge swing from negative RM 94 million in Q1 last year. It shows the core business is fundamentally good at generating cash.
So strong finances. What about market position?
Huge factor. They are a leader in the Malaysian market with very strong brand equity. Think Heineken, Tiger, Guinness, powerful brands.
And it's basically just them and Carlsberg, right?
Essentially, yes. It's a duopolistic beer market. That structure naturally limits intense, cutthroat competition. It provides pricing power and market influence.
High barriers to entry for anyone else wanting to jump in.
Very high. And that structure directly reinforces the benefit of inelastic demand we talked about.
Right, because there aren't tons of cheaper alternatives readily available.
Exactly. That allows them to implement price increases more effectively, supporting margins and knowing demand will likely normalize. People have their preferred brands.
Okay, so zero debt, strong cash flow, market leadership, brand power, inelastic demand. Anything else?
Disciplined cost management, which we know they're focusing on. And those strategic investments in digital infrastructure, the DBB and easel platforms.
Those ones hitting margins now.
Yes, but seen as part of the moat because they're long-term investments to enhance efficiency, agility, and order management, future-proofing the operations.
which ties into their evergreen strategy.
Precisely. That strategy itself is part of the moat. It's designed to future-proof the business.
Can you remind us of the key pillars of evergreen?
Sure. It focuses on superior and balanced growth, being consumer-centric, pushing premium brands, funding that growth through cost and value efficiency,
Okay.
raising the bar on sustainability and responsibility. They have ambitious targets like net zero carbon in scope 1 and 2 by 2030 and the full value chain by 2040.
Impressive targets.
Becoming the best connected brewer through digital and tech, creating a unified customer ecosystem, and importantly, unlocking the potential of their people.
It sounds very comprehensive, and sustainability is a big part of it. Does that translate into ESG performance?
It does. Heineken Malaysia holds a 4-star ESG rating from analysts, which indicates above adequate integration of environmental, social, and governance factors.
What are some examples of their ESG initiatives?
Well, environmentally, they've already reduced carbon emissions by 36% against a 2022 baseline by the end of FY22. That net zero target by 2040 is serious.
And waste.
They've achieved zero waste to landfill since 2017, way ahead of their 2025 target. Water consumption is efficient, around 3.0 hectoliters per hectoliter of beer, similar to Carlsberg. And their WATER project aims to replenish 1.5 liters for every 1 liter used.
That's significant water stewardship. What about the S&G social and governance?
Socially, they report a high talent retention rate of 93% in 2024, good average training hours per employee. Governance-wise, they have 43% female representation on their board.
How does that compare?
It's notably higher than Carlsberg's 29% and also exceeds the Malaysian Code on corporate governance's standard of 30%. They also dedicate 10% of their media spending to responsible consumption campaigns.
So these ESG efforts aren't just window dressing, they add to the moat.
I'd argue they do. They enhance reputation, build operational resilience like water efficiency, attract conscious investors, and demonstrate responsible leadership. It reinforces their long-term competitive advantage.
Okay, that paints a strong picture of their internal strengths and strategy. Let's broaden the view now. Connect this to the macro level. Malaysia recently unveiled its 13th Malaysia Plan, the 13MP.
Right, the long-term blueprint for the nation.
How might this national development strategy impact Heineken Malaysia and the wider alcohol industry?
Well, the 13MP-themed redrawing development covers 2026 to 2030. It aligns with the government's Madani economy framework.
And the impact on the consumer sector. Analysts seem mixed.
TA Securities, for instance, views the overall impact as broadly neutral for the consumer sector. But for beverage companies like Heineken, there are potential positives and negatives.
Okay, let's start with the positives.
The plan aims to boost household income significantly, targeting RM 12,000 per month by 2030. It also targets higher tourism contributions, aiming for RM 137.6 billion by 2030.
Tourism is key for them, right? Especially on trade.
Definitely. Initiatives like Visit Malaysia Year 2026 are part of this. Management already noted a recovery in on-trade demand, likely linked to tourism picking up. So higher incomes and more tourists could certainly benefit the industry.
Okay, that's the potential upside. What about the negatives in the 13MP?
The plan explicitly includes a widened pro-health tax mechanism.
Ah, there it is again.
Yes. It's set to expand beyond just sugary drinks to include tobacco, vapes, and alcoholic beverages.
So that reinforces the regulatory risk we talked about. Potential for higher alcohol taxes is baked into the national plan.
It seems so, which again could lead to near-term volume moderation and potentially fuel that illicit trade issue.
So the 13MP presents both opportunities from growth and risks from taxation.
A double-edged sword, you could say. This brings us back to the competitive landscape. How does Heineken stack up against its peers, especially Carlsberg, in light of all this?
Right, crucial comparison. As you said, it's essentially a duopoly. That structure limits intense, direct competition day to day.
But how do analysts see them relative to each other? Valuations.
Okay, looking at analyst forecasts for FY2025. HLE Research projects Heineken's PE ratio, price to earnings, at 15.8 times, with a dividend yield of 5.6%. TA Securities has slightly different numbers, PE of 14.4x, and a dividend yield of 6.9% for Heineken.
And how does that compare to Carlsberg?
TA Securities puts Carlsberg's FY2025 PE slightly higher at 15.3x and its dividend yield at 6.5%.
So quite similar valuations overall. PEs in the mid-teens, yields around 6-7%.
Yeah, broadly comparable. And Heineken's dividend consistency, that 40-cent declared, aligns with its peer. Carlsberg faces very similar challenges and opportunities.
Potential tax increases, the inelastic demand dynamics.
Right. Analysts like TA Research expect Heineken to implement those price increases to 2% to 8% in a similar range to its competitor as well. They tend to move somewhat in tandem on pricing.
So this comparison suggests that while both giants face the same market conditions and regulatory wins, maybe those fundamental strengths we discussed for Heineken, particularly the zero debt, strong cash flow.
The Moat factors.
Exactly. They might give Heineken a slight edge in navigating these challenges more effectively, even if valuations look similar on the surface. That debt-free status is a powerful buffer.
It really seems to be. Okay, so bringing it all together, this deep dive shows Heineken Malaysia navigating, well, a period of moderated performance.
Clearly marked by cautious consumers and those strategic digital investments.
Definitely. Yet their underlying financial health seems incredibly strong. Market leadership is undeniable. And that strategic foresight reflected in the 810 financial Moat score.
It really positions them to weather future challenges, doesn't it, despite the Q2 dip?
It does. While regulatory headwinds, those potential tax hikes, and maybe the persistence of those digital investment costs, they do present near-term pressures.
No doubt. But the company's ability to generate strong cash, maintain that zero debt status, leverage the inelastic demand, it underscores a fundamental resilience.
And the national context, like the 13MP, throws in both opportunities from growth and risks from taxation. It'll definitely shape their path ahead.
It's a complex picture, but the core strengths seem solid.
So for you, the listener, as you consider Heineken Malaysia, maybe the provocative thought to carry forward is this. In an evolving market like this, how much weight should you place on a company's foundational strengths, the moat, the long-term investments, even when they temporarily dent the bottom line?
Compared to focusing solely on those immediate quarterly fluctuations.
Exactly. What does that balance tell us about identifying true, enduring value creation over the long haul? Something to think about.